The world is chaotic. The future is never clear. I've made my whole career buying assets that other people consider uninvestable. And when you do that, you have a chance of getting a bargain.
Howard Marks is one of the greatest investors of our time. With a net worth of $2.2 billion built through his legendary firm Oaktree Capital Management, he is a master of value investing. And recently, he gave us a rare glimpse into his thoughts on the US economy, Trump's impact on the stock market, investing in China, and a lot more. So in this video, let's check in on Howard Marks' sea change, the great turning point for the US economy he has spoken about so much, and how we should thus be investing in 2025 and beyond.
The world is chaotic. The future is never clear. Some people spend their time trying to figure out the future and pricing it. I say it's unclear, and we abstract from that.
To understand Howard's insights on the economy and future investing outlook, it's important to understand how he thinks as an investor. Unlike most fund managers that try to make money by knowing more about the economy than the other guy, Howard is the complete opposite, rarely giving economic news any attention at all. This is called a bottom-up investing approach, focusing on individual companies and focusing on what's knowable rather than trying to predict macro events.
So we just try to look at individual companies and figure out which ones will grow, which one will repay their loans, and deal on that basis. We call that bottom-up, not top-down. We're not market timers. We're not macro forecasters. You could have said, if you had a great foresight, you could have said in 2019, I think there's going to be a pandemic. I'm going to get out. In 2021, you could have said, I think that Russia's going to invade Ukraine. I'm going to get out. In 22, you could have said, I think Hamas will attack Israel. I'm going to get out. You would have been right about the events, but it would have cost you a lot of money.
And that's always the problem with basing your investment decisions off macroeconomic factors. It's impossible to know the market's reaction. For example, Howard talks about 3 really big negative news stories in markets over the past 5 years: COVID, Russia's invasion of Ukraine, and Hamas attacking Israel, which fired up all this conflict in the Middle East. Now, here is the timeline of those events plotted on the S&P 500 price chart. As Howard says, if you were making investment decisions based on any of those 3 major global events, you would have lost out on some big returns. So instead of guessing the future, Howard's advice is simple. Analyze what you can control, like the fundamentals of individual companies. But okay, that then brings us to the fundamentals, like valuation. Sure, we might not be making a call on the macro, but it's well understood that across the board, stock prices are really, really high. The CAPE ratio, which is like a big conservative PE ratio for the S&P 500, currently sits at 38-39. So how does Howard think about this overvaluation in the market? And how does this problem, which is seen even in bottom-up analysis, influence his investing?
You talk about how it is about intrinsic value. Everything else is baloney. But how do you get intrinsic value in a market that's overpriced? I mean, valuations are skyrocketing, especially on the S&P.
Well, you say it's overpriced. I would say it's high-priced. Overpriced is a judgment call. You know, you think about what you think something is worth. You compare how it's selling relative to that. And then, in my opinion, that should determine whether or not you're aggressive or defensive. So I think we would agree that U.S. stock valuations, for example, are on the high side relative to history. That would tell me to be a little less aggressive than usual, a little more defensive, but not necessarily to get out.
So Howard agrees, most stocks are expensive out there, but that doesn't mean you should throw in the towel, log into your stockbroker, and just sell your portfolio. In Howard's view, it simply means you should adjust your portfolio and your philosophy to being a little bit more defensive, something that I've been doing recently with my own portfolio on Stake. Also, I do just want to give you guys a quick update on my partnership with Stake, because I have had a few questions. Stake are Australia's 3rd largest share trading platform, but no, they are not the Stake gambling site. So to those saying that I sold my soul to a gambling company, that is not the case at all. The Stake I'm working with is a highly reputable investing platform here in Australia. I've been using them for the past 6 years. They're good. Their big mission has always been about making the US markets easier to access for Aussies and Kiwis. Now, since then, they've also expanded into ASX trading as well. So if you are from Australia or New Zealand and you're in need of a better share trading platform, if you sign up to Stake using my referral code, which is new money, you'll actually receive $10 of free trading credit for funding a new Australian account and a free US stock when you fund a new Wall Street account if you're looking to buy American stocks like Apple or Tesla, etc. And another thing, if you already have a brokerage account, if you transfer an Aussie portfolio larger than $1,000 across to Stake, you'll get $0 ASX brokerage for 12 months. So you can transfer from any existing platform in Australia, and you'll also keep your HIN, your holder identification number. So it's a pretty good deal, sweetener. And again, I just want to say a big thank you to Stake for being awesome and agreeing to be long-term supporters of the channel. They're actually the first company to ever reach out to support my channel back when I had absolutely no subscribers. The referral link will be in the description or the pinned comment, and don't forget that code NEWMONEY when you sign up. But back to Howard Marks and how to adjust your investing approach in the overvalued market. And as he says, it's not about giving up, rather just adjusting to be slightly more defensive. But what does this mean in practice? Well, for one, it means checking in with your portfolio to ensure you're not really overexposed to an overvalued stock or an overvalued sector. So making sure you've got some level of diversification and protection against, say, a big correction in US tech. And then the other defensive strategy that Howard goes on to talk about is to have a little bit of a cash buffer to prepare yourself for any eventuality. It's what he's doing, it's what Buffett's doing, it's what I'm doing. Because here's the thing about stock markets. Yes, we know that the market can stay irrational for an extremely long time. But the way markets work is they go through cycles of excitement and over-optimism, and then they swing back down through fear and pessimism. But given time, they'll always at some point revert to where they ought to be. If they're running hot, eventually the earnings lift to justify the price, or the market falls to correct. And on the other end of the slope, in recessions and depressions, the earnings will either fall to justify the low valuations, or the prices will pick back up once investors realize that things aren't that bad. Somewhere in the middle of those swings is where the market price ought to be, and the market will eventually get back there. So if the market is up super high, it pays to have some levels of cash on the sidelines in preparation for that correction. Whereas, during the GFC or during the bursting of the tech bubble or in the depths of the Great Depression, you want to have all of your money in the market because you want to be fully invested to maximize the opposite trend, the swing back up to where things ought to be. So there's no predictions that the market is going to crash next Tuesday. As Howard says, it's just about adjusting your approach between more aggressive or more defensive based on the market conditions you're currently presented with.
It's just a matter of calibrating, in my opinion, your behavior between aggressiveness and defensiveness. When things are a little high as they are, a little more defensive than usual, but this notion of risk on, risk off, in or out, buy or sell, that's too black and white. It's not fitting for the world we live in. Getting out is really a big step. Most of the time in my 55 years in this business, it's been a mistake.
So if you've been seeing the news stories, the YouTube videos, the podcasts telling you to sell now, please ignore them. And this is overwhelmingly backed up with data. Shout out to the visual capitalist for this one. This is a chart showing the value of $10,000 invested in the S&P 500, but what then happens if you miss the 10 best days or the 20 best days and so on. Now this is across a 20-year period from January 2003 until December 2022. And as you can see, if you stayed invested, your $10,000 would have turned into $64,844. But if you miss the best 10 days, your portfolio drops by 35 grand down to just $27,000. And as you can see, you can only miss the best 30-something days before you actually end up with less than what you started with. And a quirky stat they've included here, in 2020, the second best day happened immediately after the second worst day. So if you think you can see the up and down trends in the market, think again.
Not only do we never know what's going to happen in the bigger world, but we also don't know how the market's going to react. And so to be dogmatic and to say, it's high, I'm getting out, is a mistake.
And with that context under our belt surrounding how Marks views the current investing landscape, I also wanted to touch on two big issues that were covered in this interview. And the first is Howard Marks' opinion as to how Donald Trump's presidency will impact markets. This is the first time I've seen Howard speak since the results of the election, and this is what he had to say.
You talked about how it's hard to do it on a short-term basis. Okay, let's take a longer-term basis. 4 years, the Trump administration. How are you looking at that? How might that impact market sentiment and how this plays out?
Again, these things are very hard. Number one, what's going to happen? Nobody knows. His appointments are not firm. They have yet to be confirmed. His policies are not known. What is he going to do? Nobody really knows what he's going to do. And number two, what else will be going on in the world? He's not the only show. It's complicated. Number three, how will the market react to all these things? Number four, the president's influence on most things is usually quite limited. Number five, as I said before, our economy is in good shape. So in general, things are going well in the United States and or better than most other places. And that's why things are high in the United States. The situation is generally good, but you're paying a lot for it. we'd like to get a good situation at a bargain price. It's rarely the case. I don't think things are crazy high now, and I don't think it's time to get out.
By now, nothing Howard has said should come as a surprise, and he's right. So many investors will try and make stock market bets based on elections or policies, but honestly, it is a fool's errand. You can lump it in with macroeconomic data. It's interesting, but it shouldn't drive your investment decisions. And just to prove how irrelevant it is, take a look at this. Stock returns under Democrat and Republican presidencies since the S&P 500's inception are almost identical. Howard also touched on the resilience of the US economy, which we've seen play out even with rising interest rates. Employment figures and output remain strong. But as he noted, that resilience is part of why valuations are so high. And that brings us to the other big topic that Howard was asked about, which was China. Now, Marks holds positions in companies like JD.com, Pinduoduo, Alibaba, and NetEase, and these stocks face the opposite problem. They've been beaten down along with China's economy in recent years, and some see this as a rare opportunity, while others are calling it a value trap. So with recent stimulus measures announced, how does Howard Marks approach this controversial topic?
I mentioned before that the U.S. situation is doing well, but high priced. The Chinese situation has fundamental questions, but it's bargain priced. Which is better? You can't. It's all investing. It's a matter of relative choices.
But with the risk that its nascent recovery might be jeopardized by Trump's policies and further tariffs on the economy.
Well, if you can tell me what Trump's really going to do as opposed to his rhetoric, and if you can tell me whether Trump's rhetoric is going to induce behavior on China's part that makes Trump back off from his rhetoric, then I may know the answer. But nobody can do that.
But as we know, the long-term performance of Chinese stocks won't be from tariffs or a trade war with the US. While the reporter zeroed in on the newsworthy topic of the day, of course, the bigger problem with Chinese stocks is that their recovery is going to depend heavily on whether or not China can turn its own economy around. And the answer obviously lies somewhere in its property sector, which has been a key driver of economic growth for decades, but now, as we know, faces significant challenges. Declining house prices, stalled projects, developers going bankrupt. But as we're about to hear, if China can stabilize and reignite its property market, as they're now trying to do with this large stimulus, the hope is that it could fire up its economy as a whole, and that's really the focal point of Howard's perspective on long-term investing in China.
Anytime you have an amount of building which is highly stimulated by the availability of capital, then you have to go through a period of adjustment in which the buildings that have been built are absorbed. You have to grow into that space. That doesn't happen overnight, and it doesn't happen because the government turns a policy lever. The question is not whether they have to do it. The question is, will it bottom out? Will they stop adding excessively to the property stock? And will they put in place policies designed to create the absorption? My bias is that they will. Many people in the investment community describe China as uninvestable. To me, that word is music to my ears. I've made my whole career buying assets that other people consider uninvestable, and when you do that, you have a chance of getting a bargain. So I think that clearly China is on the pile of things that people feel ill about, and it's on that pile that you find the bargains. That doesn't mean that you should buy everything on the pile, but that's where you look for the cast-offs and the bargains.
And it's that philosophy that's led him to make those 4 investments I touched on before: JD, Pinduoduo, Alibaba, and NetEase. Even just a simple look at the PE ratios of these businesses show that they're quite a bit less expensive than their US counterparts, with all values under 20. Sure, it's definitely not for everyone, and Howard himself acknowledges that there are risks there, but as he noted, being a contrarian is one of the core reasons he's built such a successful investing career, and it's not something he's afraid to do. So there are Howard's thoughts as to investing across the next year. Definitely have to balance optimism and caution, stay focused on intrinsic value over noise, be a contrarian where it makes sense to do so. But I think the most important message was just to stay the course. Don't get sucked into short-term thinking.
Investing in the short run is very uncertain, and nobody should think they really know what's coming. And most people should take an almost passive approach. The idea is it's good to invest. It's good to invest in the United States. It's good to invest over time. And it's bad just try to mastermind it in the short run with get in, get out. Now, if everybody gives up on getting in and getting out, you may lose a few viewers. But the point is, investing is a good thing. Do it early, do it a lot, so that you can build the nest egg. Don't screw it up.
But with that said, guys, please leave a like on the video if you enjoyed it. And if you're an Aussie or a Kiwi, be sure to check out Stake using the links in the description and the pinned comment. I would really, really appreciate it. But with that said, guys, thanks very much for watching, and I'll see you all in the next one.